Hey folks, Dan Frio here, the rate update. Today is November 3rd, 2021. It's Fed Day. The news out there is they're going to taper. What does it mean? So when you come back, I'm going to explain to you what tapering means, why they're doing it, what effects it's going to have on the economy, especially housing and mortgage rates. So don't go away. We'll be right back. Today is Fed Day, and it's probably one of the most important days in the Fed's history, up in the top 10, let's put it that way. So what's going to transpire today, and so what's been happening? So let's kind of dissect this whole thing. So when the pandemic hit, the Federal Reserve stepped in and said, you know what, we're going to try to stabilize a lot of the markets, especially mortgage rates and the economy and everything else. So what they did is they started buying in the tune of $120 billion a month bonds, especially mortgage-backed security bonds, to keep mortgage rates stable, because the housing market is one of the biggest pieces of the puzzle in the economy, makes up at least 15% of the GDP. Okay, so what they're going to do is they're going to step in and they're going to say, we're going to start tapering back that $120 billion a month. And what that number is going to be, it's anticipated between 5 and 15 billion a month is what the taper is going to be. So let me make this clear. Right now, they're buying 120 billion in bonds. Okay, 40 billion of that is mortgage-backed securities to keep a lid on mortgage rates. All right. So what's going to happen is when they start to taper. Now they're not going to start raising rates until probably the middle or end of next year, maybe, and that's all up in the air. And I'll give you my feedback on that at the end of the video. So make it clear they're not raising rates. Okay, and the one rate that they affect is the federal funds rate. Okay, so let's make that part clear. They're going to stop or start reducing the amount of bonds that they buy, because what's going to happen there is the demand is going to go down. Okay, so when the demand goes down, what happens is prices start to go down to spur up more buyers. Well, what happens in the bond market when you have prices going down? Rates or yields go up. Well, when the Fed announced this about a month or two ago and said, we're pretty much planning on tapering, we saw a big move in the market. And I'm going to go through all those technicals with you here in a minute. But let's just scale back for a second. And the Federal Reserve has two mandates. One is full employment. Two is to what we call price stability, aka inflation. So let's dive down into those areas to see what's the news right now, that the most recent news the Federal Reserve is looking at when it comes to the job market. So here's today's jobs report.
Time for the October ADP report. Steve Leisman has that number. Steve, what can you tell us?
571,000 ADP stating that private payrolls in October rose by 571,000. That is higher than the estimate September revised to 523,000 from 568,000. Here you go. Here are the numbers. Goods sector quite well, 113,000. Services sector even better, 458,000. And there's the estimate for Friday, 450. I'd say it's kind of in line. We'll talk about the errors on ADP in just a second. Looking at it by business size. Interesting developments here. Large business up 342,000, medium 114, and small 115. This is the second month in a row that large businesses have had outsized gains. It seems like beginning in September, there's been a decision at some of the bigger companies, at least, to hire more workers and to be more aggressive here. It's interesting to see if that continues or if small business can catch up. Large business may have an advantage here when it comes to an environment with rising salaries. By sector, leisure, hospitality doing well again, 185. Professional business services, trade and education, construction, 54,000. Those are all good numbers by sector. I do want to caution you. We've done some work this morning looking at the errors of ADP. They were okay. They were in line before the pandemic, plus or minus. These are absolute numbers, 65,000. During the pandemic, they've been plus or minus 774,000. Of course, those were big errors from the worst times of the pandemic. And then lately, they're down to 266. Lest any private sector economists crow about their forecasting prowess, guys, I looked at the private sector forecast. It's not been much better at all. In fact, during the pandemic, it's been about 1 million plus or minus on a monthly basis. But that said, going into the Fed meeting today, I think that Fed Chairman Jay Powell would certainly rather have stronger jobs numbers when he faces an inflation problem compared to one where jobs were weak. So Becky has maybe less of a choice to make. If he has these strong jobs numbers, it's going to be a whole lot easier for him to tighten policy, Becky.
So from that report, you can see that the job numbers are good today and they're upticking. That was my assumption that what was going to happen is once the September excess employment benefits lapsed, people were going to be basically forced back to work. Now, it wasn't going to happen immediately. People they procrastinate a lot. So they might hold off for the best offer. They might hold off for this. They might just say, you know what, I'm just going to take another month off and because I'm financially okay right now and do that. So that's the first part of this equation. Again, the Federal Reserve mandate, jobs at full capacity and inflation, keeping a lid on inflation. So based on that, what's the inflation outlook look right now?
Why do you say central banks around the world are in a denial phase, Jim, when it comes to inflation? And does that apply to the Fed as well?
Yes, it does apply to the Fed. What's happened in the markets in the last couple of weeks is short-term interest rates have moved up and moved up a lot, especially in countries like Australia and New Zealand. That is a market signal that they're saying that you're behind the curve, inflation is persistent, and you've got to start thinking about moving your policies more aggressively towards tightening. Now, none of these central banks want to do that. They're in denial that the markets are telling them that. But eventually, if the markets stay at these high interest rate levels on the short end of the yield curve, signaling that they should be moving faster, they'll eventually come around to accepting that. And I think you're going to start to see more aggressive rate hikes in 2022 than most are giving credit for.
Okay, well, as that stated, inflation's going bonkers. So the employment numbers are looking better and better and better. Inflation is really getting out of control, but the biggest thing there is it going to be transitory or is it here to stay? That's only going to be found out over time or history. When we look back 6, 8 months, 10 months, a year from now, has the inflation started to dissipate? I actually anticipate yes. Once people get back in the job in markets, and they have to get back to normal spending and earnings and everything else, everything will start to come back in line. And what I mean by everything is the generic stuff out there. Now, like used car prices, they're skyrocketing right now. Are they going to come back down? Yeah, they'll find an equilibrium. Same with housing, believe it or not. And we're going to discuss more of that in detail. At the end of the video, I'm going to give you my analysis on what 2022 is going to look like. Okay, so that's that part of the equation. So the next thing is what I want to talk about is when the Fed makes a move today, they're going to taper. So we kind of know on this video and some other videos that I've done what tapering means, all right? But when the Fed says now we're going to start increasing rates, what do they control? Okay, they control the federal funds rate. So let's break down what is the federal funds rate and what effect is it going to have on the markets. So if you're not familiar with the federal funds rate, basically what is it? Well, the term federal funds rate refers to the target interest rate set by the Federal Open Market Committee, the FOMC, basically the Federal Reserve. This target is the rate at which commercial banks borrow and lend their excess reserves to each other overnight. Okay, pretty simple. So you might be saying, well, doesn't it affect mortgage rates and car loans and all this stuff? No. Okay, let's go back down to here. The rate also influences short-term interest rate, albeit indirectly, for everybody, from everything from homes and auto to credit cards, as lenders often set their rates based on the prime lending rate. The prime rate is the rate banks charge their most creditworthy borrowers, a rate that is also influenced by the federal funds rate. Okay, so you can see it indirectly affects this, not directly. All right, so now what's the difference between the federal funds and regular interest rates? Well, the chief distinction is that the federal funds rate sets the range that banks will lend or borrow to each other overnight. Okay, that's the federal funds rate. It doesn't have anything to do with other interest rate, mortgages, car loan, credit cards, and everything of the sort. So to wrap all this section up, the Federal Reserve is coming out today saying what they're going to do in regards to their bond purchases and also the direction that they anticipate using based on when they're going to adjust the federal funds rate. Okay, but again, all this stuff isn't a direct impact to bump up rates. Okay, it's just pulling out or tapering their bond purchases. The expectation is probably, I'm going to say March, April, May, they're probably going to start looking to increase the federal funds rate. I still think they're going to give it a little bit of time to see how these numbers wash out in regards to employment. And are we going to start seeing inflation start to dissipate now that a lot of workers are back and a lot of the excess fundings or excess stimulus packages have been pretty much removed from the markets? So let's go over all the headlines today. And let me just, again, the media is going to pump this thing to make it sound like maybe the world's going to end. But let me decipher it for you guys so you don't have to freak out. The Federal Reserve is about to set post-crisis policy course with a level of uncertainty ahead. What does that say? I mean, who knows? The next thing is October payroll numbers. We already went over that. Fed is in denial about persistent inflation. Wall Street forecasters Jim Bianco warns. Okay, everywhere you go, you're seeing inflation, job numbers, all this other stuff, because today is Federal Reserve Day. So now let's put a kind of a bow on this thing. They're gonna announce today that they're going to taper. When they're tapering, it could be today, it could be next month, it could be January. Let's say it's a relative right now. And the reason why I'm going to say that is the markets have already corrected. So here's where we're at. And this also plays into the point where do I think rates are going to be in the next 6 to 8 months? Okay, this chart kind of sums it all up for us. When the Federal Reserve came in to the market right in these ranges here, it's basically when the world started to crash, the pandemic. You can see it right in here. Okay, rates were, the MBS market was down here. Now let me give you the correlation again. The lower this number, the higher rates are. So when we see this number right here, this is what's happening to the price of the mortgage-backed securities. Okay, when it's down, there's an inverse relationship with the price and rates. Okay, so what happened is when the pandemic hit, the Fed stepped in and they started buying up mortgages to make sure there's a soft landing when we come out of the pandemic or through the pandemic. So look at the rise in the MBS price from January of 2019 or 2020 through July. Look at that run. It's crazy. All right. And you can see it right here, January of 2020. And then it goes through, and now we have March. This is right when the pandemic, really started raising its ugly head in a bad way. All right. So it raised the MBS prices, which plummeted rates to basically historic lows again. As you can see right in here, January 5th of 2021 was basically almost the lowest in history, if it wasn't. All right. So that's where we've been through this ride. And over the last course from March of 2020 through now, it's kind of been steady. Look at it. We're like the 104 mark over on the right side. Look at it. We pretty much, that dissects this thing in half. All right. So that's the run that we've taken. Now, when everything comes back to normal or starts to normalize, the MBS prices are going to continue to drop. Okay. And again, as the price drops, rates go up. So where do I expect things to be in the next 6 months to 8 months? Well, if all of these chartings make sense, we should be back to where the normal levels were back pre-pandemic. Now, what were mortgage rates at that time? For that, let's go to the Freddie Mac website and look at what the monthly historic rates were from 1971 to now. Well, all we're going to really focus in on is right in this area here. Where were they, let's say, December of 2019 or around that area? October, November, December of 2019? Well, great question. We were right here. Okay, so you can see that from 2019. Oh, let's go back all the way to January. 446. Okay, so that's where we were January of 2019. This would be, the pandemic wasn't even a whiff back in that time. So where do I expect us to be? Well, we're going to get to that level. So I'm anticipating within the year we'll be at 4.5. But I anticipate it's going to be a gradual progression there. We had an overreaction when the Fed stepped in and said, oh, we're going to start tapering. But the uncertainties there is how much are they going to taper? Well, let's assume that the tapering takes effect. It goes all the way through until May, June, July of next year. And then the free markets are now taking over where it was here. All right. So we're going to gradually move our way all the way up to, I'm saying 4.5 to maybe 4.75 a year from now. All right. So is that going to be the end all beat all for housing? Well, no. Let's dissect the numbers. What's affecting the housing market right now? The biggest thing I think is supply demand in the pandemic. Okay. Here's why. In the pandemic, people they were going crazy. They're like, I need to get out of my house. I'm now have to work out of my house. I spend basically 24 hours a day in my home. I can't get in, I can't make it in this 2-bedroom apartment. I want a house of my own, right? That's one of the biggest things. 2, it's still an American dream. If you want to believe it or not, it's still an American dream. 3, it is a wealth creator. So let's say this. Let's say houses don't even move a penny in the next 5 years, but you bought, okay? I don't anticipate values plummeting. I don't even really anticipate they coming down a little bit. They probably will because the bidding wars are going to be over here probably in the next 3 months, okay? Because there's going to be ample supply coming in the markets. And I'm going to tag this video so we review this next June so I can see how my predictions went. But here's my predictions. Forbearances are going to be completely over within the next 3 months. Those people, then it's going to be that time of year, spring, where people notoriously start to move. Okay, why? Kids are starting to get out of school shortly after that, and everything. That's just the spring season is the hottest market from there to about July or August. Why? Because that's the best time people can be transitory if they have children. All right, because if you have kids in school, you don't want to move during the school year or so forth. So March, April is usually the hottest times all the way through August. All right, at that time, all forbearances are going to be over. A good portion, or let's say half those people just finally say, you know what, I can't do this anymore. I need to sell. So if they sell, there's probably going to be at least 500,000 homes back on the market. Plus, you're going to have people that are saying, you know what, I'm going to move. I'm going to cash out on this house, get in all my money, and then I'm going to go upgrade or do whatever. Is that a prudent move? I don't know. It's only for you guys to tell. But you're going to have also those people moving. Also, it's notoriously the same time of year that people move. The pandemic's out. They can get in the market. They can get back in the market, look at homes and everything else. So look at it. If you can get in the market now and find a house, you can go view the house. You have more houses to bid on. You don't have the bidding wars. You're going to probably buy. Okay, so that's my anticipation there, as long as house prices aren't just completely stupid. But again, what 2 options do you have for living? Rent or buy? So let's get back to what I was talking about. You buy a house now and it's worth $300,000. And you stay in that house. It doesn't increase in value or decrease in value for 5 years, 10 years, nothing. It's stagnant. Okay, but let's think about it. Your house is valued at $300,000. You financed it. Let's say you put down 5% and you had a mortgage at $280,000. Over that 10 years, you paid down the loan to $200,000. It's probably more than that, but let's just say $200,000. So now your mortgage is $200,000 and the value of your house is $300,000. You have $100,000 in equity. If you don't do anything, you sold the house, you're pocketing $100,000 less closing costs. So even if the housing market doesn't move a penny in value, it's a forced savings account for you. Plus you get tax benefits for owning a house. Depends on what political parties in place, but sometimes you have better tax advantages than you do at other times. So that's where I'm anticipating the market to be next year. So a strong, robust housing market, no more bidding wars. Rates are going to go probably in the tune of 4.5 to 4.75 by the end of next year. And that's my analysis of what's going on. So I hope you find value in this video. If you do, give me a thumbs up, subscribe down below, hit the post every time I post a video, you get an alert. That's it for now. I will be posting later today once the Fed does announce, and we can dissect exactly what they did say to see if what my propositions are that I'm saying hold true in the short term. And then next year, time will tell. I'll try to post that video maybe June 1st. I'll put it in my calendar to repost this video and see how accurate my thoughts have been. So thanks again, guys, for watching. God bless. If we could be of any help to you guys, if you're looking for a mortgage, you're looking to build a house, you want to think, hey, does it make sense to refinance? Do you want to consolidate some bills? Please reach out to us. I'd love to help you. How do you find out more about me and my team? Well, the best way to do that is go to therateupdate.com. And you can give us a call at 844-775-LOAN. You can find us on our online application. You click right here. It's state of the art. It's really cool. It'll take you about 10 minutes to complete. Or you can schedule a meeting. Most people do this because they want to talk to us. They want to see what we can do behind the scenes. We share our screens with you. If you do it by Zoom, we can show you what your rates look like, what your credit looks like, everything and anything there. The one tool we just came out with, if you're in the market right now for a mortgage and you want me to analyze or review your loan estimate that you got from your lender, please go into the rateupdate.com. Under resources, you're going to see it says upload loan estimate. Just click in that. It'll take you to a secure site. You're going to click through it, and it's going to come here. Just give me information on how to get back with you. You can even just leave an email address if that's all you want to do. I will review your loan estimate and get back with you within an hour if it's during office hours. What I'm going to do is make sure you guys are getting the best rates in the market. You guys are paying the lowest fees in the market, and we answer all your questions. And one thing, the most important thing, is to make sure you're in the right loan program, because being in the wrong loan program can cost you thousands of dollars in unnecessary fees, points, and interest. God bless, guys. I'll hope to hear from you soon. Take care. Bye-bye.